Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, US stocks recovered from their losses intraday into the close to finish slightly higher, S&P up 30 bips. Europe did drift slightly, and China rallied ahead of Q1 GDP numbers that came out overnight and beat expectations. Commodities consolidated, with metals and oil pulling back from recent strength. Nat gas was the sole performer, up 6%, adding on to last week's gains. Volatility levels lower again, as both VIX and S&P expiries this week do look like they're going to put more pressure on the curve. It seems like dealers in general have got themselves long vol, long gamma, and that is just getting kind of liquidated into these expiries. European vols did bounce though. They've been trading at cheaper levels. Eurostox vol around 13 there, got down to 12.5, bounced off those levels. And then China vols were relatively muted, considering it was up nearly 3% yesterday. Vols relatively unchanged there. In commodities, oil and copper vols were up about a vol point apiece, but other vols were kind of mixed to not doing too much. Looking at the carry side of things, still lots of positive carry as Western markets do appear pinned this week due to this large dealer gamma positioning that we were banging on about last week. Asia does seem freer to move though, and has more neutral carry. Obviously, China moving around a bit. Japan had some good moves last week. Oil and copper providing decent positive carry for the vol sellers in commodity space, whilst other commodities are more neutral right now. In terms of skew, most equity skews are back, excuse me, to the 20th percentile. But we did see China skew take a hit, down 1.5 vols there, down into the 6th percentile, as people obviously looking to maybe play the upside if this kind of China reopening starts to really show up in the data. Commodity skews were mixed. Oil and uranium softer, nat gas higher. Despite that rally in spot, nat gas skew did still catch a bid. Looking at the charts, the question I'm asking is gold the next pain trade? Gold has obviously performed really well this year. Dollar's been weak. The rates hiking cycle's coming to an end pretty much globally. Obviously it's kind of staggered as to when that exactly happens, but in general, we're getting towards the end of the rates hiking cycle. However, looking at these charts, this kind of 2050 area on gold, third time we've tested it, haven't broken it yet. It's pretty strong resistance here. We did have a quick sell-off again on gold recently. Speculative positioning has been going higher as well to one-year highs. So we do wonder if the market's kind of next place to inflict pain. Clearly, it inflicted a hell of a lot of pain in the rates market earlier in March. The question is, does it now need to inflict some pain in gold, in precious metals, which maybe have been getting a little bit crowded, similar to the dollar short story that we've been talking about as well. Whilst we agree that the long-term allocation to gold does make sense, we have taken off tactical longs, and we have been using risk reversals to hedge out any silver exposure that we've got, because we do think that there is room for a bit of a pullback. Real yields have also popped in recent days. The dollar's near a pivotal level on a long-term chart as well. So there's definitely scope for gold to pull back. And if central bank buying does take a pause, and yields continue higher for a month or two, then there's no reason why we can't see gold back in that 1930 to 1960 zone. That would be considered a healthy pullback. I'd like to see the price action, what it looks like if it gets down there, and then maybe think about re-entering some longs to finally play for the breakout, which we do think ultimately does happen. We do think we're going to pop our head above this level at some point this year. We're just not so sure that at this point in time it's going to happen. Okay, moving on to the VIX. So the VIX has obviously been collapsing quite a bit. Obviously, we've been pretty bearish VIX. We've been quite loud about that. This support zone 17 to 18, though, we did expect that to hold. So we've been a little surprised to see it just smash through there. The VVIX, on the other hand, you can see this green one. This is the VVIX. The VIX is the candle chart. So typically, these things kind of move together. Often the VVIX actually leads the way. But because we've seen the VIX accelerate lower and the VVIX kind of not really do the same in holding, it makes us think that this VIX sell-off might be a bit of an overshoot, and we may well get a mean reversion back in the VIX, more in line with the fact that VVIX is held. We have, obviously, earnings season does typically bring focus to single stocks, and index vol is often used as a funding leg. and that allows books to own volatility on individual names, sell index volatility to keep their theta bills down. That's a strategy known as dispersion. So that might be explaining some of the weakness in index vol as well. We've also had cross-asset vol weakness as well. So, all these things are playing a part. We personally want to use this recent weakness in the VIX to get long May 23 expiry VIX delta. We want to play for that mean reversion. We think it's got oversold. We do still think there's uncertainty for markets to contend with over the next month. And obviously, those who follow our options overlay portfolio in our weekly product will know that we've been long April VIX puts, which have done pretty well. And we're going to be closing out the balance of those today. Okay, looking at our VIX Monitor, obviously the VIX curve is steepened pretty dramatically. You can see that here from these big drops that we've seen in the front end. Now the roll down has gone back up to 11%. The roll down is basically the difference between the front two futures divided by the level of the VIX. So it doesn't really, typically it kind of lives in that range of, let's call it 5 to 8%, something like that, but it's stretching to 11% looks pretty rich. I don't expect that to hold. Now the VIX beta as well, something we look at. Let me just clear this so you can see it. The VIX beta, 1 month VIX beta is this orange line. It has popped to about 1.6 and 1.5 actually, yeah. And what that basically tells me is the sensitivity of the VIX to the S&P is dropping. Okay, now that typically happens as the VIX number goes down. As the VIX number gets to low levels, you kind of don't expect on a rally in S&P for the VIX to have material more downside. Okay, and that's what we envisage happening. So if we were to get a break above 4,200 on S&P, after expiry, let's say this Friday, we would expect vol to not collapse and maybe find some support. And we know that VIX spot up dynamic, sometimes when that does kick in, that is often a lead indicator to a correction in markets. Okay, so we think the market may well be setting up for that type of scenario where vol gets annihilated this week to the point where it can't really go much lower. Realize remains low because the market's pinned. Then suddenly the market's more free to move. We get one final squeeze higher, takes us through 4,200. Vol actually goes bid on that because all the sellers are gone, basically, and people want to replenish their gamma. And then the market rolls over from those levels, right? So that's kind of the scenario that we think is probably the most likely. VIX options continue to see sellers of puts, buyers of calls or call spreads in May. So we've seen some 25, 30 call spreads trading. We've seen some 20 puts getting sold, 21 puts getting sold. So bullish flows we are seeing in May, people opportunistically trying to get long that stuff, similar to what I'm basically saying and what I want to do. Okay, looking at the dashboard, clearly we're in buy call territory. That doesn't mean you close your eyes and go and buy a load of calls on the VIX because they tend to bleed quite fast. So we are in buy calls, but looking at the skew, minus 40 vols, that means call skew is very much apparent there. Looking at the curve, looking at the vol carry being positive, these things all to me point to buying call spreads rather than straight calls. Last week we pitched a slightly more complex structure, broken wing butterfly. And the reason we did that is we wanted to expose ourselves to a pop in the VIX potentially, but we weren't convinced that the VIX bottom was in yet because we were heading into this expiry week where we thought things were going to get quite pinned, right? Now that we're into that and expiry is on Wednesday, so that's tomorrow, we do think starting to buy something with a bit more delta on it does make more sense. So something like a straight call spread, 1-for-1 call spread, something simple is starting to look a bit more sensible now. All right, guys, thanks a lot for listening. I'll catch you all tomorrow. Cheers.